Good afternoon and welcome to the webinar hosted by the Investor Responsibility Research Center Institute about our latest report with Harvard Law, The Materiality of Human Capital to Corporate Financial Performance. Our agenda today is brief introductions, a review of the research, comments from IRRC Institute on their perspective, and then we'll take your questions. Just a few words on the webinar logistics. All attendees are in listen-only mode, but we do encourage your questions. You'll notice there's a question function on your control panel. During the webinar, feel free to type in any questions that you may have, and we'll answer those questions at the end of the presentation. Following the webinar, you'll receive an email with a link to this PowerPoint presentation you're seeing here right now, and we'll also post a replay of this webinar that you can listen to it later at your convenience. This report and all others from the Investor Responsibility Research Center Institute are located at www.irrcinstitute.org at no charge. We encourage you to share information on social media about the report. Our Twitter handle is @IRRCResearch and use the hashtag IRRCResearch. If you have any problems with the audio or any technical difficulties during the webinar, you can contact GoToWebinar at 1-800-263-6317. Our speakers today are Aaron Bernstein and Larry Bieferman. Both gentlemen co-authored the study. They're with the Pensions and Capital Stewardship Project at Harvard Law School's Labor and Work-Life Program. Aaron is going to do the bulk of the presenting today. He'll run through the PowerPoint presentation. Aaron helped co-found the Pension and Capital Stewardship Program in 2008. He's also the editor of Global Proxy Watch, a corporate governance newsletter, and previously he was a reporter with Businessweek for 23 years covering workplace and social issues. Larry Bieferman is also on the call with us. He will join us for the Q&A portion, and he also co-authored the report, and in 2004 he joined Harvard Law, the Labor and Work-Life Program, to help establish the Pension and Capital Stewardship Project. Also on the call with us today, the webinar, is John Lekumnik. He's the Executive Director of the IRRC Institute. He's been the Director of the Institute since 2008, when the organization was established, He has decades of experience working on investment issues, including the investment advisor to the New York City pension funds. And under his leadership at the IRC Institute, he's built a reputation for the organization as a credible source of objective and unbiased research on a broad range of investor issues. Just a couple words about the IRC Institute if you're not familiar with it. It was originally established in 2005 and got up and running in 2008. It funds and disseminates research on a broad range of investor issues. It's both academic and practitioner research. The Institute sponsors an annual research award, which gets a lot of publicity, and we encourage you to learn more about that. The deadline is approaching soon. We have a 5-year impact report available on the website, www.irrcinstitute.org, and all research, as I said before, is available online at no charge. Here's just a quick listing of some of the research that has been published by the Institute, everything from executive compensation to high-frequency trading, cybersecurity, and hydraulic fracturing. So it does cover a wide range of issues of interest to investors. And now we'll move on to a presentation about our latest report, and I will turn it over to Aaron. Aaron?
Thank you very much, Kelly. Larry and I started working together some years ago on an initiative to help investors figure out how to get a handle on social factors and try to develop metrics that investors could use to assess the long-term risk of such factors. As I'm sure most of you know, there have been a fair number of studies on governance and the environment and much less on social factors. We did some initial papers on labor and human rights and the investment risk that they posed. And over the years, as we worked together, we realized that there's quite a bit of literature on the social factors that we're talking about here in this paper, which have to do with human resource, including training. So we decided that investors could learn from hearing about that literature. So that's what this paper was an attempt to do, bring it to the attention of investors. So basically, there's a vast literature on human resource management by corporations. Hundreds of studies have been done on various aspects of this topic. So what we did is we went through and pulled out the studies, identified and analyzed the studies that focused on standard investor metrics, total shareholder return, return on equity, profit margins, etc. And the goal here was to identify papers that tried to look for correlations between human resource policies of corporations and standard materiality metrics that would be acceptable under SEC and US securities law. So we weren't looking for papers that analyzed normative concerns about human resource policy, of which there are numerous examples. We decided we wanted to focus strictly on what is often called materiality, particularly in the US. So basically, a lot of these the studies that we found use standard regression analyses. Some of them link to stock prices. Some of them actually use perceived measures of profitability and performance. And they do that as opposed to objective measures like what's the stock price or what's your published profit margins. And they do that usually because they're comparing public companies as well as private companies, or because they're comparing units of companies. Overall, we identified 92 studies that fit the criteria we were looking for. These covered more than 4 decades. They go back stretching into the 1970s, and they covered dozens of countries and industries. About half of the ones that we looked at, or that we identified, were from the US and the UK, although that's probably at least partly because we were looking for studies that were done in English. So you'll see here on the table here of the 92 studies, this is just sort of an overall breakdown. We found that we broke out training separately from human resource policy. Overall, 67 of these studies had positive findings. We tried to look for the primary finding in each study. Most studies have multiple findings, but most studies also say this is our sort of core finding. And when they didn't, we tried to sort of identify that ourselves. Another 17 studies had mixed findings, mixed meaning they had one or more positive findings, and then they would either find mostly no correlations, because usually when you do regressions, what you find is that there's either a correlation or there's not. A couple of them would also find negative correlations. That's much rarer. 7 found no correlations, and 1 study had only a negative correlation. So overall, the conclusion we came to was that there was the bulk of the studies show evidence that human resource policy correlates to standard investment metrics. So the reason we broke out training separately from HR, I mean, obviously training is a human resource policy, but over the decades, it has become its own sort of subgenre, and many studies, including the 32 we identified, look at training separately from other human resource policies. And they find positive correlations when they look at training in isolation. So we thought it made sense to follow the literature and break out training separately from HR, even though it really is an element of HR policy. So to start with training, the sort of general theory about why training enhances corporate financial performance is multi-layered. The first is that directly what it does is enhance employee skills and knowledge and abilities, and makes them better at doing their job in a variety of ways. That in turn leads to improvements in the way the company is run: productivity, product quality, service quality, customer satisfaction. And those in turn produce higher sales or profitability and ultimately stock prices. So the correlation between training and the end output of corporate performance is mediated by what happens in the company. And there's 2 kinds, sort of broadly speaking, of training. One is general training, which is kind of like going to high school or college. You get trained in how to run machinery, how to, write, how to do whatever you need to do to work at that company. Specific training is just what it sounds like, which is in our company, here's what you need to do. Here's how you run this piece of machinery. Here's how you do a sales call, on our particular products, whatever it is. And the two sometimes differ very sharply in general and specific. So that's led to a considerable amount of research in the field, which is wrapped up in these studies. So training lends itself to a fair number of specific metrics. The most obvious one is how much a company spends on training. So that can be measured in a couple of ways, three ways, basically, which is how much per employee, how much per firm, or as a percent of total payroll. Then there are sort of more amorphous ways to measure training, which don't have specific numbers attached to them, like does the company have a training policy? What is that training policy? What percent of the workforce is trained gives you a little bit more of a handle, although that can be not as specific as it sounds like, because it sounds like it should be, because people do include part-timers in the workforce, you apply subcontractors, sometimes companies train subcontractors, so that gets a little bit stickier, but the other measure that can be used is time devoted to training by the company, by the employees. So there's a variety of ways to get a handle on how companies are doing training. So we picked one study out of all the ones we identified that focus specifically on training, just as an example here. It was done by an American named Lori Bassi and some of her colleagues. And one of the things that was interesting about this is, unlike most of the studies that did regression analyses, what they did was they looked at 388 U.S. Public companies that between 96 and 98, and they divided them into quartiles, and their conclusion was that the companies who spent more on training per employee averaged higher stock price returns, 31% annual stock price returns, and those in the bottom quartile averaged 15%. So they found very clear correlations to stock price and investment outcomes. So turning to HR policies, we have a table 4 that you can see in the paper there, which lists 60-some different kinds of policies. This is so when you consider HR policies overall, it's a much more broader category than something like training, which is just one policy. So what you have here is sort of the headlines under which each of one of these you'll find multiple policies on how companies compensate their employees, how they design jobs and work, how they do training and development, recruiting, employee relations, and so on. There's a wide range of policies that companies can adopt in each one of these categories. So that has led academics to, when they first started looking at this field, most of the studies would pick out a particular policy and try to analyze what impact it might have on intermediate steps like productivity at the company or customer satisfaction, and then ultimately investment performance. And after a while, basically in the 1990s, people realized that human resource policies should be and often are complementary, and they work together. So a company would design a compensation policy to fit with job design and other aspects of their human resource policies. So academics then started looking at bundles of policies, and at another aspect of this was people would call it high performance work systems, which you may remember was the vogue in the 1990s. So that those two sort of merged into what is called policy bundles. And a lot of the studies on human resource policy use this sort of bundle analysis, which can get very complicated, but is basically a strategy question. So to, again, pick an example, one of the studies that really sort of kicked off this field here in 1995 looked at high performance work systems in the US, and they examined 968 firms with 100 more employees. And here they used regressions, and they found positive correlations to Tobin's Q, which is a sort of a firm value, and return on capital employed. And they concluded that companies with high performance work systems outperform other companies that lack those systems. So as you can imagine, there are a number of limitations in these kinds of analysis. The first one is a causality question, which is, do companies with good policies perform better, or do companies that perform better have enough money to pay their workers better or have other kinds of good policies? There's been a lot of literature on this, a lot of discussion about it in each of the studies. By and large, the conclusion is that the causality runs the way you'd kind of expect, which is good policies lead to better performance. It's not completely a settled question, but that's certainly the overall conclusion. A more difficult question is, okay, bundles of policies. Well, which bundle makes sense? Here, the conclusion is there's not really a template. So just like corporate strategies overall, are going to differ by industry, by market, by corporate leadership. Human resource policies are the same way. So investors need to sort of figure out what policy bundles the companies have, and then figure out, like they do with a corporate strategy, does that make sense? Another question here in the literature that is a limiting factor is intermediate step that I talked about earlier is often called the black box question, which is you put in a human resource policy and all these intermediate things happen in the middle, or supposed to happen anyway, like better productivity, and at the other end out comes higher corporate performance. But how exactly you track that as an outsider or an academic is very difficult. So that's academics have spent a lot of time trying to figure that out. They've done a pretty good job, but it is a limitation because you can't track that exactly, or it's very difficult to track it exactly. Overall, the conclusion we have come to after looking at all these studies is that human resource policies can affect corporate financial performance positively or negatively. It's difficult for investors to get their hands around that without a lot of data. And there's an opportunity here for for investors to ask companies and their ESG providers to provide them with this kind of data, both at the very broad level of what's the company's HR policy, just what's the strategy, what's the policy, as well as metrics and training per employee, that kind of thing. For companies, there's an opportunity here too, which is, they have an opportunity to say, especially if they have a good HR policy, here's our policy, here's how it relates to our business strategy overall, and here's some key performance indicators that we use to track and implement these policies. Most big companies already produce that kind of data, and they use it internally. They don't produce it publicly, but they could if investors ask them for it. And obviously there's a market opportunity for ESG providers. Some of them do a pretty good job of looking at some of this stuff already, but none of it's really comprehensive. They could play an intermediary role here between investors and companies, as they do for other kinds of ESG data, and ask for relevant information and put it in a usable form that investors could use. So I will stop there and turn it over to John Lekumnik, who has a few points that he would like to raise. John, over to you.
Thank you, Aaron, and thank you and Larry for the study. I'm really excited about this study. I'm excited for a very simple reason. The S part of ESG, as Aaron and Larry said in looking at the academics, it's long been tempting. It was very challenging. It's challenging for investors. Let's take this down to how do you make money from it? How do you make sure your companies are creating value over time from it? Aaron said it's aligned with strategy. You can think of it as This is the execution. This is the tactic of the strategy. You can have the best strategy in the world. If your workforce can't accomplish it or accomplishes it less well than a competitor, you are going to lose. We've all seen sports teams that have brilliant game plans and lose because they just lose the battles. And it's intuitive. It's very difficult to take advantage of because, as Aaron said, the studies are all over the place. There aren't standardized metrics. There's not the equivalent of generally accepted human resource policies. But that's fine because it has to align with the strategy. But it's also intuitive that it should make a difference. And in fact, it should make more of a difference today than it did a year ago. And it will make more of a difference in a year than it does today. And it'll make more of a difference a decade from now. Because all the traditional accounting metrics were geared towards financial capital. We are getting to a world where human capital is increasingly more important. And I know we all know that, but I just want to give you a statistic, not from the study, but from the NABR, that suggests how much we are moving to a world where human capital matters more than large plants and equipment. In 1990, manufacturing was the leading employer in 36 states. By 2013, that was down to 7. 1990, the same year, services was the leading employer in 2 states. By 2013, that's up to 39. So these issues are ever increasing in importance. And so not only have Aaron and Larry identified the fact that they are financially material, but when you cross-fertilize that with what is happening with the economy today, they are becoming ever more vital for investors who are looking to do things. So to sum up, human resources policies, human capital management is financially material, affects performance of companies. It is more important than ever before. It will be even more important. But it's really hard to look at from the outside coming in. Now, you can look at that last statement 2 ways. One is, I don't know what to do with this stuff, right? This is all interesting. It's all intuitive. We know it should matter. You've proven it's matter. So what? How do I take advantage of it? Or you could say, wow, this is really an opportunity for us to put a little effort into it, study it, and get it right, because it's not the same data everyone else gets. And so I think there is a rich reward for people who get this right. I have the advantage, being the host of the webinar, to know who's on the call. There are rating agencies on the call. There are really smart institutional investors on the call. There are asset owners on the call. One of you guys is going to figure this out, and you will have a competitive advantage over everyone else who's either not on the call or didn't put in the effort to try and get it right. So with that, I'll turn it over to Kelly, and we can take some questions.
Great, thanks, John. Okay, now we're on to the Q&A portion of the webinar. If you look on your control panel, there's a question box. Just click on that triangle and you can type in your question and we will read that aloud. Available for questions are the co-authors, Larry and Aaron, as well as John LeCum that can ask your questions. So you just bear with me 1 second while I exit out of this so I can pull up the question box. Okay, so the first question we have, sorry, maybe I missed it. So increased performance correlated to stock performance and also employee pay?
Not to employee pay. There have been studies that look at that. In fact, a lot of studies. But the ones that we looked at found correlations to increased stock performance, to profitability, other kinds of measures of company performance, not the benefit to employees. There's a whole literature on benefit to employees from training and human resource policy. We didn't look at that because we decided to look at sort of investment metrics for corporate performance.
Thanks, Aaron. Our next question, what companies are already disclosing data on training, HR strategy, and the relationship to materiality?
Well, that's a good question. Basically, it's not. There are very few companies that disclose this publicly. Um, there's been there's two aspects of that. One is we looked at 92 studies that correlated HR policy and investment performance. Almost all of them were done by practitioners or academics doing surveys, which they sent to corporations. They all got enough data back. So companies are perfectly willing to talk about this. And in fact, there were also several studies done, particularly in the UK, where they asked companies, do you collect and track this kind of information already on human resource policy, on training expenditures, et cetera? And what they found is most corporations, especially middle-sized and larger ones, have fairly elaborate internal reporting mechanisms for gathering data about their own human resource policies and what they spend and how they manage it. They don't report it publicly because, well, basically nobody asks. So it doesn't seem like it's a real competitive secret by and large. Sometimes it might be, and some companies might feel that way, but overall, dozens of companies and thousands of companies in dozens of countries have produced information over the years for these studies about what they do on HR policy. So it's not a big secret, but there's not much demand for it, at least publicly. So the answer to the question is not many companies do it, but they appear to be willing to do it if investors ask.
Thanks, Aaron. Our next question, some funds supposedly use social indicators. Do you know if that tactic is generating beta data?
Social indicators. Well, I don't know. I'm familiar with some of those. We discussed briefly, Corporate Knights does a report. There hasn't been much good data on this overall. There hasn't been a sort of a focus on HR policy coming from those kind of reports. So the Dow Jones Sustainability Index has got a couple of questions on this, and we've actually talked to them over the last year or two about adding some questions on it on HR policy. So there's some data there, but not very much at this point.
I would also just add that a lot of the data that is available on the S part, when you say they do social gathering of investment, is sometimes what I would consider the compliance side of it. For instance, conflict minerals, do you track it? Do you use them, etc.? And I think that what makes Larry and Aaron's research compelling is the logical conclusion to a corporate specific strategy. There's always the tension for investors between comparable data and relevant data. And I think what this would seem to, we don't have comparable data, so let's start there. And I think what Aaron is arguing for is that we should be asking initially for relevant data so that we can then see if there are overlapping pieces of data that can be comparable.
This is Larry. Just want to add one thing. I think I think you tend to see, at least look at some of the kind of the management consultant firms, and some of the things that I see with companies is and this ends up with some of the ESG reporting. They have sort of a mixture of reporting. That is, there's a reporting about policies, and they're reporting about certain kinds of outcomes of policies. So I think you need to distinguish between the two. So, for example, in terms of that black box, the question of turnover may be important in terms of the cost of retraining, the loss of expertise, and all the rest. That's, in effect, an intermediate outcome, potentially ultimately linked to financial performance, but turnover is a manifestation or a reflection of one or another policy within the overall HR and company strategy. I think you've got to be able to distinguish between and among them.
Thank you, gentlemen. Our next question, which studies provide the best methodological guidance for investors on how to gather data from companies on their human capital management techniques?
Well, this is Aaron. Best studies. Well, the best study is probably one that we're going to have to do. which actually we have been thinking about doing. So there haven't really been studies that specifically say what should investors ask for. Um, they instead pose questions that researchers want to find answers about, correlating HR policy to investment outcomes, but they don't ask, they ask the questions themselves, but they don't sort of say, well, here's what investors should ask to get the right questions. Now, some studies have kind of tried to summarize what companies should say. They haven't quite put it in terms of investors, but you kind of get there. And basically they start by saying sort of what you'd expect, which is ask companies to describe their corporate HR policies and strategy. So first you want to know their policies, then you want to know how the policies fit into an overall HR strategy, and then you want to know how does the HR strategy fit into the company's corporate competitive strategy. So to take a sort of an obvious example, Costco has a high wage, high quality, high customer service strategy. Their HR policies, I mean, I haven't studied them, but I'm certainly familiar with the overall sort of description of them, which is they have a high wage strategy. They pay their workers above market for retail. They have high job retention. So they have a HR policy that sets of policies that fits an HR strategy, which fits their competitive strategy in the industry of getting higher value, higher margin business. So that's the kind of thing that investors can ask companies to provide. There's, back to this question about policy bundles, there's lots of different options. So you're not going to have a template and saying, well, here's a checklist of what I should ask companies, because it's going to vary by the company's strategy, by the company's industry, by the marketplace, does the company operate, what country it operates in, or are there a lot of a lot of highly trained workers already in that market available for the strategy they want? So there's not a checklist of questions. It's more you want the company to tell a story about what their HR strategy is and give data and hopefully numbers, key performance indicators to sort of back it up and flesh it out.
Aaron, if in addition to reading this study, if you were going to recommend one or two of the underlying studies to the people on the call, are there one or two that you would recommend?
Well, probably. The British government has done a lot on this topic over the years, and there's a couple of studies that they have done called that have looked at this. They've done it over the years, and there's a group called CIPD, cipd.co.uk, where you can find a number of the studies that have looked at this issue. The program is called, well, it's had a couple of variations over the years, but right now it's called Valuing Your Talent, and it's a combination of, CIPD is a professional body for HR research. It's a combination of the CIPD, the UK Commission for Employment and Skills, Investor in People, which is a government program. Anyway, there's 4 or 5 groups. They've done a lot of work on this, and they've probably done the best overall summary. It's specific to the UK, but it's certainly applicable beyond that.
Great.
Thank you. The next question, who is collecting and selling data?
Yeah, that's kind of back to this, sort of similar to the earlier question. To John's point, there's a market opportunity here for somebody to do that. I mean, all the ESG houses, or at least most of them, do offer some kinds of data on this, on human resource policy.
Yeah, I'd rather not give specific names. There are 100 raters, about 12 to 15 that are seriously competitive in the marketplace. Some have more regional focus than others. But all of the major governance and sustainability rating houses collect some aspect of this data. It is not the primary focus of any of them, as far as I'm aware. So they will all tell you what data they collect and how it is aggregated and presented in terms of their analyses. So, I just don't want to give a commercial endorsement to any one or the other on this.
Thank you. Our next question, why do you think mainstream investors have paid so little attention to these kinds of findings?
It's hard. How's that for a two-word answer?
That's a pretty good answer.
In all seriousness, it's hard to, I can scrape SEC filings and get financial data and run a bunch of ratios and apply my type of factor analysis to it. This may have more impact on a factor analysis on the long-term value creation of any one company, but because there isn't standardized data, because there isn't standardized reporting, it's hand-gathering information. As Aaron said, these were done by survey, which means you actually have to sit down and contact 100, 200, 300, however many companies. And so this is not, I'm not underestimating the challenge of doing this, but I think that because it's hard, because it's differentiated, there can be a value add to it. But I think that's the reason it is not widespread today.
Yeah, I think there's another aspect as well, which is, we started this project because we were sort of generally familiar with the field and knew that this research was out there. But boy, when you try to wade through hundreds and hundreds of studies to pick out the ones that look at corporate financial performance specifically, it's a big job because the literature in this field is vast. So it's understandable that investors wouldn't really have pulled that out. And in addition to that, most of this literature is done not for the investment world. It's not presented to investors. It's done by business schools, management consultants. It's done for corporate management by and large, for HR professionals. So I don't think the message, the world is a kind of a siloed place, and I don't think the message has gotten to investors that this kind of information can be material to corporate financial performance. And even if it does, like one study estimated that there have been 10,000 studies on job satisfaction, HR policy on job satisfaction. So to expect investors to kind of go wade through all this and pick out the ones and realize, wow, this stuff is material, we really need to think about this and figure out what to do about it. I don't know, that's never happened. It's just too big of a field, and we're not focused on investors.
Thank you. Our next question, if investors ask companies for all this HR data, would that put a costly new burden on them?
Yeah, so, well, yes and no. I think I said a few minutes ago that there have been some studies asking companies, trying to figure out, do they already collect this kind of data? And by and large, the answer is yes, they do. A lot of companies have very elaborate key performance indicators and other metrics about their own internal processes, and that includes HR. So it's not like you're saying, okay, now we got to go out and collect, like the debate about CEO pay, and companies would say, well, CEO pay to average worker, we got to go collect all this data. I don't even know if that was actually true, that they had to go collect new data, but that's what companies said. But in this case, I don't believe that will be true for most companies, or at least for many companies. And that's not just in the US, but and not just in industrialized countries. Across the globe, companies collect data when they manage their workforces. So maybe don't produce it publicly, and so that may be some work there. They may have to put it figure out what's competitive and they want public, or and then they have to put it in a form that's usable, but it's not like they're going to have to go start collecting all this data. And in fact, the companies that say that, that's a pretty good indication of their HR strategy. If they are not collecting this data already, they don't have a good strategy, I would guess, because this is, if you have any kind of workforce, you need to manage these kinds of policies, and you can't manage without data.
Thank you, gentlemen.
This is Larry. Just, although I would add, and I don't know if Aaron would agree, but at least from what I can tell, even among companies which collect data, I think I saw some reports from the Boston Consulting Group, I think from McKinsey, some work associated with the Harvard, I think it was Harvard Business Review, that there are companies that collect data, but how effectively they use that data is a question. And I think that's part of the conversation. Part of it is whether you collect the data in the first place. And the second question will tell us how do you meaningfully analyze and use that to assess the effectiveness of your HR policies.
Thank you, gentlemen. And it looks like that concludes the list of questions that we've received. We thank everyone for participating in the webinar. Again, the research is available at www.irrcinstitute.org. We'll send a follow-up email that contains the link to watch a replay of this webinar. And we'll also post this PowerPoint presentation on the IRRC website. If you have any other questions, of course, John, Larry, and Aaron are happy to take your questions, and their contact information is below on the screen right here. Thank you again for joining the webinar, and we hope you have a terrific week. Thank you.